$65,000. That's how much my client takes home every single month from a business he bought for $2.5 million with just $125,000 of his own money. If you're sitting there thinking you need millions in cash to buy a profitable business, I'm about to completely shatter that belief, because some of the smartest acquisitions I've seen involve buyers who had less money than the annual salary of the business that they bought. In this video, I'm going to walk you through the exact 3-layer financing structure that made this possible, show you the due diligence process that revealed this opportunity, and give you the step-by-step roadmap to replicate this yourself, even if you've never bought a business yourself. Hi, I'm Mike Freedman, and I've personally brokered well over $100 million in online business acquisitions. But here's why that matters to you. I've been exactly where you are right now. I've been the nervous buyer wondering if I'm making the right decision. I've been the seller trying to protect my life's work. And I've been the operator running these businesses day to day. Last year alone, I personally acquired 3 multiple 7-figure businesses using these exact strategies. But here's what's different about this case study. Most people think buying a business works like buying a house. You save up 20%, you get approved, you write a check, but that's completely backwards. When this client came to me, he had $300,000 saved and was looking at a $1.5 million business max. Every calculator online told him that's all he could afford. He was about to settle for a smaller deal that would have made him about half of what he makes now. That's when I stopped him and said something that changed everything for him. What if the amount of cash you have is almost irrelevant to the size of business you can buy? He thought I was crazy. And honestly, if somebody told me this when I started, I would have too. But what happened next proves why 90% of buyers are leaving millions of dollars on the table. But before I show you that exact structure, you need to understand the 3 financing strategies that made this possible and why the third one is the secret sauce that most brokers don't want to share with you. The first strategy is SBA loans, and I need to destroy a massive myth right now. Everyone thinks SBA loans are for dry cleaners and restaurants, and they're dead wrong. They're one of the most powerful tools for acquiring profitable online businesses, and here's why that will blow your mind. SBA loans for business acquisitions require just 5% down, not 20% like real estate, not 25%. 5%. I learned this the hard way when I missed out on a $3.2 million SaaS deal because I thought I needed like $320,000 down, and it turns out I really only needed about $160. That business sold to someone else and is now worth about $8 million. And so that mistake cost me personally over $7 million in equity. But here's the exact SBA process we used. Step 1, pre-qualification with an SBA approved lender before looking at a business. This is a massive win because when you call a listing and say, I'm pre-qualified for $3 million in SBA financing, the brokers take you serious immediately. The second step is targeting SBA eligible businesses only. This will save you months of time. The business has to be a US-based company, and it has to have 2 years of tax returns and meet financial requirements. But as long as it's a US-based business and a US corporation with a few years of tax returns, most businesses can qualify for SBA loans. Step 3, structure for maximum SBA coverage. They'll finance up to 95% at a maximum of $5 million. The result for my client was a monthly payment of about $35,000 on a business generating over $65,000 in monthly profit. That's over $30,000 take home from day one. If you want a free affordability calculator that tells you exactly how much company you can buy, there's a link in the description below. All right, so back to the story. We didn't stop there. A second layer of financing is where this deal went from good to absolutely incredible. Layer 2, seller financing. This is where most buyers chicken out, but it's actually where sellers make their best deals. The seller carried $500,000 of the $2.5 million purchase price. And now you might be thinking, why in the hell would a seller ever do that? Well, I'll tell you, in well over $100 million of successful transactions, seller financing appears in well over 90% of deals. And here's why sellers accept it. Reason 1, you get a higher total price. So instead of $2 million in cash, they got $2.5 million, and that extra $500,000 in seller note compensates them for their time. Reason number 2 is because of taxes. Instead of getting hit one time, they get to spread their money over a couple of years. But here's the structure that made this seller note genius. We had a 5-year term at 8% interest, and the first 2 years were interest only. Let me break this down a bit. Years 1 and 2, the buyer paid $3,300 a month to the seller in interest only payments. And then years 3 through 5, about $15,700 in monthly payments. I've structured over 35 seller notes, and this interest-only period is the secret weapon. It gives new owners time to optimize the company before those full payments kick in. And in this case, we already identified over $300,000 in annual profit improvements just through better marketing automation and operational efficiency improvements we identified. And then by year 3, when full payments start, the business has grown and can easily cover them with the extra cash flow. But how do we know this business was even worth the asking price? Well, this comes down to due diligence and experience, and what I discovered will change how you evaluate every single business opportunity moving forward. So layer 3, the due diligence process that revealed why this was worth $4 million and not $2.5 million. Most sellers price their businesses based on simple multiples. Annual profit times 3 or 3.5 and they're done. But smart buyers take a deeper dive, and understanding this gap is really where the fortunes are made. I've developed a due diligence framework from analyzing over 1,000 businesses. And this specific process has helped my clients avoid almost $50 million in bad deals and identify $23 million in hidden value. So we saw 3 things that some buyers completely missed. Discovery 1 was recurring revenue structure. Clients were on monthly fee plans, multi-annual contracts, and companies are valued at premium multiples for predictable cash flow. Discovery 2 is that market position dominance in this company. Number 3 player in a growing niche with high barriers to entry. Some buyers saw this just as a consulting business, and we saw this as a strategic asset. Discovery 3 was growth trajectory over time, 20% year-over-year growth for 3 years in a row. My clients saw sustainable compounding growth. And here's our exact due diligence process. Week 1, financial analysis. 3 years of statements, tax returns, rebuilding income statements from scratch. Week 2, we jump into market research, detailed industry analysis, and growth projections. Always buy business in a growing industry. And then week 3 was operational assessment, key employee assessment, process documentation, review, risk analysis, etc. I once skipped customer analysis on a $1.8 million acquisition. It looked great at first, but then I discovered like 40% of the revenue came from one client. It cost me a lot of time, and I'll never do that again. Always check client risk and preliminary assessment. But the real secret isn't just finding these opportunities. It's having the financing strategies in place that let you act on these opportunities while your competition is still figuring out how to pay for the down payment. Beyond this case study, here's an extra financing strategy that can 10x your buying power, but 95% of buyers never even consider it, and no broker wants to share it with you. I've used this personally, and it's helped generate over $30 million in equity from my clients just in the last 18 months. Earnout structures for high growth businesses. Instead of paying full price up front, you want to structure part of the payment based on future performance. So as an example, I just closed a deal that included $1.5 million up front and then an additional $500,000 if gross profits were hit over 2 years. The buyer got a lower initial price, but the seller got upside potential and both sides won. Most brokers don't get paid a commission on the earnout portion, or they get paid a reduced commission on this earnout portion, so they'll likely never tell you about it. This strategy has made 6 of my clients millionaires in just the past 2 years, including one who bought a $2.3 million agency for just $120,000 down. But enough theory, let me show you what happened to this specific deal 6 months later, because the results will prove why this system works. So 6 months post-acquisition, the numbers speak for themselves. The business now generates $1.1 million annually, which is about $330,000 more than when he bought it. After all debt service, he makes $58,000 a month, which is more than 40% of our country makes working full 40 hours a week. But here's the best part. Current business value based on performance is $4.7 million. Remember, he bought it for $2.5 million just 6 months ago. That's $2.2 million in equity creation in 180 days. And this is not unique. One of my clients, Sarah, bought a $1.2 million business with just $80,000 down using SBA. She doubled revenue in 18 months, and she's looking at a $4 million exit. Mike bought a $3.1 million e-com brand with an SBA loan plus some seller note. He now does $8.5 million a year building a portfolio of brands. And Jennifer bought an agency that she worked at for $800,000 using 50% seller financing. She now does $2.3 million in revenue and employs 23 people. I know you're thinking, this sounds too good to be true. Well, let me address that directly. What if the business fails after I buy it? Well, obviously any investment has risk, but you're not buying a startup. You're buying an aged business with a proven track record, existing customers, and predictable cash flow. Plus, with proper due diligence and financing structure, you're limiting your downside significantly. The SBA publishes failure rates, and it's under 5% in the last decade. Compare that to 90% failure rate for startups. What if I can't get SBA financing? Well, as long as you have a 650 credit score or above, some semi-relatable work experience, and 5% down for the acquisition, you can pretty much get approved. And what if you don't qualify now? Clean up your credit score and save up a little bit of cash, and that's all it takes. What if I don't know how to run the business? Well, there's 3 safety nets for that. 1 is seller training, typically 3 months or more. 2, the existing team stays. And 3, you can hire consultants. The business already generates enough profit to afford expertise if you need it. Most of my clients had these exact fears when they bought their first business, but typically the seller training is incredible. The team has tons of expertise. And if you need more help, hire a $5,000 a month consultant for 6 months. It'll be the best money you ever spent. My clients acting now are making money and gaining incredible experience and expertise because they're moving while others sit on the sidelines waiting for that perfect business, which doesn't even exist, by the way, and I'll touch more on that in a separate video. But if you want to be one of them, you need to stop thinking and start acting. Here's exactly what to do next. Step 1, download the free affordability calculator I created. It tells you exactly how much company you can afford to buy. The link's in the description. Step 2, start researching businesses. Platforms like BizBuySell, Flippa.com, website closers. Check those out, set up some saved searches, understand what's available and how businesses are priced. And then step 3, if you're serious about acquiring in the next 12 months, get pre-qualified for SBA financing. This single step puts you ahead of 90% of buyers. Just reach out to me if you want me to introduce you to my lenders. The acquisition market is incredibly active right now, but this window will not last forever. As more people discover these strategies, competition increases, and deals get expensive. Every successful business owner you admire started exactly where you are now. They had doubts, fears, questions, but they took action despite uncertainty. The difference between people who built wealth through business ownership and those who don't isn't intelligence, it isn't education, it isn't capital, it's the willingness to move from thinking to doing. That affordability calculator is waiting for you in the description, so download it and start building the foundation for your first acquisition. In the next video, I'll dive deep into the due diligence process, mistakes that kill 80% of deals, and I'll show you the exact red flags that saved my clients millions of dollars last month alone. Till next time, thanks.